I want to go over a trade today that I just closed on Best Buy. I'd placed a Strangle on Best Buy back on October the 16th. Now, I actually placed this in one of my larger accounts. It's not part of my small account trade, mainly because of how much of margin it requires. When I placed the trade, it required me to hold about $1,200 in cash to cover the trade in case it went against me. I made a couple of mistakes, and that's one reason I want to review this trade. Well, two reasons. One, so you understand I do lose money. And the other reason is to kind of identify the mistake I made on this Strangle. And it's really pretty obvious now that I look back, and truthfully, I missed it when I first entered the trade. So what we're looking at is my Bollinger Band indicator. And what I saw here was that Best Buy had traded back toward the mean on 11/16, which meant that I could place a Strangle that would put my short call and my short put beyond this 2 ATR, and I felt pretty safe about that. But what I really didn't take into consideration is the fact that this Bollinger Band has started to contract. And typically they'll contract before they explode in one direction. And you can see it better on the TTM squeeze indicator when it's red here. This is a free indicator on TD Ameritrade on the Think or Swim platform. When it's red, it means that it's getting ready for a move in one direction or another, or it's a possible indicator of that. And as you can see, this was red when I entered the trade. And in fact, it turned green the very next day. So if I'd waited one day, I would have had a higher opportunity here to make this trade work. But I ignored this. And I entered this trade because basically it was trading at the mean. Implied volatility has started to move up a little bit, which it continued up, by the way, as the trade moved, which is bad for a short option position. And let's take a look at just a couple of the other indicators just to get an idea where it was at when I placed the trade. We'll zoom in. Again, right here, it was right in the middle of the wave. So yes, on one hand, I would expect to move away from the wave, but it also meant that I had distance on each side of it to place my shorts, which is what I was looking at when I entered the trade. But again, completely ignored that contraction on the Bollinger Bands, which I made a mistake. Here, it moved back to all of the moving averages and it consolidated there. Another thing I was looking at, thinking I'd have the most room on each side right here. Didn't work out that way. Well, let's go through the trade. On 11/16, I sold the November 15th 72.50 call, which was about right here. And I also sold the 62.50 put, which was down here. Now, the 62.50 put actually had pretty good protection. I had a swing low here. I had the mean. I had a 1 ATR, 2 ATR, 3 ATR move. I didn't have quite as much up here. I had a swing high here that I thought would hold. But as you can see, that did not happen. By 10/22, which is this candle here, I was pretty sure I was in trouble on this trade. Again, my short was right here at 72.50. So what I elected to do, because I was still looking, now I'm looking at my Bollinger Bands as I'm looking at the trade. I'm between a 2 and 3 ATR, move down. So I'm hoping it's going to move back down toward this mean. Normally I would wait till I saw a candle that would tell me that, which honestly this one did, but although as you can tell it didn't really work out. But what I decided to do was I rolled my 72.50 call out another week to 11/22. And I rolled it up to a 73, which put me right in this area. I was able to bring in a 4-cent credit, which is not much, but I gained a week and I moved up 50 cents. So, looking at the pattern here, I thought that would probably hold and I would be okay, even though, I got a very bad entry, which is really what doomed this trade. On 11/22, which is... I'm sorry, on 10/28. On 10/28, I got this candle here where it spiked up again. And actually, it was probably trading right around here when I decided I needed to do something else to adjust this trade. So I moved my short put up from the 62.50 all the way up to 67.50, which was right in here. and I moved it out to the 1122 strike also, so that both my call and my put would be on the 1122 strike. It just makes it easier for me to put a good to cancel order out there when I have them on the same strike. I got really lucky after that. It actually came back down into this area, and truthfully, I could have closed the trade right in here for right at break even. And normally when I make adjustments, that's what I will do. Now, once I've started adjusting a strangle, I'll put in a good to close order for right at break even, or just right above it, just so it shows as a profit. But even if I had to close for small loss, that's okay. However, on this particular trade, because I had it moving back into this mean area, and I had a pretty good candle here that showed it was really rejected hard. I elected not to do that, and I kept basically my same profit target in and decided to let this trade run. Now, of course, I knew that I couldn't roll it past 11.22 because I had some earnings coming up here pretty soon, so I couldn't really roll it again. So I was stuck at this 11.22 strike. I couldn't go out to the 11.29. So I let it run. I didn't close here where I could have. It came up again, broke through my 73 call again here. Continued up. This candle made me think it was going down. Then, of course, I immediately get this candle. Probably should have closed here, but I still had some time value left on the position, so I decided to hold. It hit this 2 ATR again. I was really watching it, to see if it was going to continue to push upward. If so, I just have to close it and take whatever loss I had. I held it and I held it and I held it, and then today, or yesterday, I saw this candle, and it got me down to a place I could close without too bad of a loss. I had this candle come up today, went all the way down here, and then as the day went on, I saw it starting to move back toward this top again, kind of like it did here. And that began to make me a little nervous, knowing that, I have a 11.22 option, which is, just a couple of days from now, and I really can't roll it again. So I'm either, unless I want to hold through earnings. So I decided to go ahead and close it, just because I was afraid it was going to continue up. I'll show you kind of what that looks like on the trade sheet itself, give you an idea. When I entered the trade on 10/16, it took a $1,200 margin to hold it. I entered it at 68.59, 34 implied volatility, and a 68% probability of success if I held to the end. You can see, this was the entry. I had a $1.30 credit when I entered it. I was looking to close for about 50% of that. I put my break evens down here so you can see those. On 10/22, it hit the point where that I needed to make it, where I had set up an alert to look at making an adjustment. I did decide to go ahead and make that adjustment, and I did it by rolling my 72.50 call to 73 and rolling it from 11.15 to 11.22. That added about another 4 cents right there. On 10/28, I went ahead and rolled up the put for two reasons. One, to bring in another credit so I can maybe get this to a higher break-even point, and two, to get it on the same cycle. So I rolled my 62.50 put to a 67.50. I brought in about 30 cents here. So I ended up with about 34 cents in credit during the roll. And then today, on 11/20, with the candle I showed you a minute ago, I decided to go ahead and just close the trade for a loss. It looked to me like it's going to head back up, so I decided to take an $88.90 loss on $1,200 risk. 7.4% loss. I do look at the annualized loss here because this is a longer term trade. It means a lot more to me on my longer term trades than it does my shorter term. Then at 35 days. Was not a good trade, but I managed the risk. I made some adjustments where I needed to make them. And I let the stock kind of play out, and again, they typically go in waves. So, I didn't take advantage of this move down here, and I should have. I chose not to take advantage of this one. Probably should have, in all honesty, because I kind of got the same setup I did right here where I took the close. But I didn't take the advantage of it here. Moved up this time. This was the third time it moved through here and gave me an opportunity to get out at not too bad of a loss. So I went ahead and finally took it here. So the bottom line is, yes, I do lose money. Also, strangles are very dangerous. If you do, they're a high risk potential trade. I only recommend them if you really know what you're doing, and you only should do them in high volume stocks and stocks that aren't likely to have buyouts or any kind of strange news. And certainly stay away from earnings unless you're doing an earnings trade. A lot of people trade strangles on earnings purposely. Uh, I have in the past, and I do sometimes, but it's not one of my typical trades. And also stay away from pharmaceuticals because any announcement, it could go from 70 to 170 or 70 to 10. And I've noticed that in the marijuana stocks also. You have to be very careful with those. Mostly you'll see me do strangles in, like Best Buy, Microsoft, McDonald's, Apple, uh, and then of course EFTs. I'll do strangles in those sometimes. I ended up in a strangle, just to let you know what was going on. The reason I did a strangle was because I was looking at Best Buy for a short and iron condor, and I could not get the credit I needed in order to make it worth it. Um, Had I done the iron condor, I actually would have taken a bigger loss because I don't typically adjust those. So I actually would have had a larger loss had I done the iron condor as opposed to the strangle. But that's just, this time it just happened that way. Please like and subscribe, and let me know if you have any questions. Thanks.